Alright, I'm going to dedicate this AP Macro video to just investment and capital. Okay, it's a big part of economic growth, so might as well make a video to review over it a little bit. Alright, so when we have capital, the first thing we have is real capital. And I use symbol K equals capital. Remember, it's not potassium, but C has already been used for consumption in our Sig X. Remember that equals our GDP. Alright. So, consumption, gross private investment, government spending, net exports equals aggregate demand. And anytime we add up all of what we spend, that's going to equal our GDP. So, our real capital is going to be our tools, machines, things like that. Things that we can use in order to make goods and services. So you take a capital good to make a consumer good. So if you buy a chainsaw and use it to cut down a tree in your yard, it's a consumer good. If you buy a chainsaw and cut down other people's trees and charge them, it's what I use to make money. So that's a capital good. So that's what we have. It's called real capital. If we need to buy or borrow in order to get our real capital, we need financial capital. And those are loans, or you can issue stock or bonds in order to raise financial capital to buy capital goods. So if I want to grow, if I want to invest in my company, that is all about financial capital. So if we have low interest rates, if the nominal interest rate is low, then people are more likely to take out loans or issue bonds or things like that in order to borrow. So that leads to investment. So I with a subscript G is gross private investment. So at low interest rates, people are likely to purchase using borrowed money to get their capital goods. And so since IG is part of Sig X, remember if this goes up, then our GDP would go up. And that's a good thing for the economy. There's purchasing, there's investment in capital. This can lead to economic growth because we can buy new capital. Say our business is growing and we buy a new truck, we need to hire a brand new driver to flourish with that business. So that would lead to economic growth. And you could even draw it like this. Okay? Economic growth. Now, we have our financial capital. We also have our human capital. And that is our skills, our brains, our abilities, all that. Adam Smith said a country's greatest resource is its people and their skills and abilities. So if we have piles of lumber, what kind of stuff can we make out of it? So we could have job training. We have education. This is supposed to be a cross. We could have healthcare. It's supposed to be my red cross. Anyways, job training, education, healthcare, coffee, whatever makes us better as humans and makes us more productive workers. So productivity leads to growth. If we have the same people, the same resources in an 8-hour day, if they become more productive, then GDP would go up, and we could even have potential GDP going up, and that would lead to growth. Okay? So all of these together are what we call our capital stock. So our capital stock includes all three of these. Now, if we want to have a positive net investment, that means we have to overcome depreciation. So in a given year, if we put more money into capital, then it breaks or depreciates. So if we have positive net investment, that means we will have economic growth, okay? Because we are adding more capital than we are using up. Because our trucks are going to break down. things are going to need to be fixed. Things are going to get outdated. They're going to need to be replaced. Okay? So if we have a negative net investment, then we do not, then depreciation is greater than our investment. If we have a positive net investment, then our investment is greater than depreciation. Okay? So if I had to illustrate those, remember it could be like this. That one would shift in, and that would be a PPC that would shift out. So that's all about our investment. Okay? It can be positive or negative. Okay? Other thing, inventories. So inventories are an investment. If you buy a bunch of stuff and resell it, that's an investment. So if inventories are going up, that means we are having a problem. We could possibly have a recession. If inventories are decreasing, that's an economic indicator, or around investment right there. If inventories are decreasing, that means we're selling stuff and we're making it and it's in demand and GDP is going to be going up. So this is all about capital. Okay? Real capital, financial capital, human capital, positive and negative net investment, and then our capital stock as a whole and as the economy. Okay? All those things are important for the health of our economy and how we could possibly grow. I hope that helps.